If large investment institutions truly believe that Bitcoin will be worth exponentially more in the future, there is a simple but uncomfortable question we have to ask. How do they buy enough of it? Not a few coins, not a speculative position. I'm talking about thousands, sometimes tens of thousands of Bitcoin. Because when you manage billions of dollars, buying a small amount changes nothing. To make a difference, you need size. And to get size, you need liquidity. That's where the story begins. Markets are not just charts and candles, they are flows of supply and demand. They are emotions translated into price. Every green candle means someone bought and someone sold. Every red crash means someone panicked and someone absorbed that panic. Here is the part most retail investors overlook. Institutions cannot accumulate large positions when everyone is optimistic. When price is rising aggressively and social media is euphoric, nobody wants to sell. Retail investors are convinced Bitcoin is going to the moon. Long-term holders tighten their grip. Supply dries up. If you are a large buyer in that moment and you try to purchase aggressively, you push the price even higher against yourself. You create slippage. You announce your presence. The market runs away from you. So when can institutions buy the most? When others are desperate to sell. Liquidity appears during fear. This is not conspiracy theory. It is market structure. Imagine a moment when Bitcoin drops 20% in a few days. Headlines turn dark. Influencers who were bullish last week suddenly become cautious. Twitter shifts from rocket emojis to funeral memes. Telegram groups grow silent. People begin checking their portfolios every hour. This is when supply floods the market, and supply is opportunity. Large players understand something retail investors often don't. Markets move in cycles, expansion and contraction, euphoria and despair, distribution and accumulation. What feels like the end to one participant feels like a discount to another. The transfer does not happen randomly. It happens between what many traders call weak hands and strong hands. Weak hands are not stupid people. They are emotional capital. They are investors without a plan beyond hope. They are leverage traders who cannot survive volatility. They are individuals whose conviction disappears when price drops 30%. Strong hands are patient capital. They are funds with multi-year horizons. They are corporations allocating treasury reserves. They are institutions that can endure volatility because they expect it. When Bitcoin falls sharply, it feels like destruction. But structurally, it is often redistribution. Think about this carefully. If an institution wants to accumulate 10,000 Bitcoin, it cannot do so quietly during a parabolic rally. There simply are not enough willing sellers. But during a crash, during forced liquidations, during margin calls, during panic, coins become available in massive quantities. Fear unlocks supply. Retail investors often say they are manipulating the price. But even without direct manipulation, the system itself creates these opportunities. Leverage amplifies volatility. Stop losses cluster at obvious levels. News cycles exaggerate uncertainty. Algorithms react faster than human emotion. All of this increases downward momentum, and momentum creates panic. In bull markets, retail investors feel powerful. They buy dips confidently. They talk about financial freedom. They calculate future net worths. But when the cycle turns, confidence evaporates quickly. A 10% drop feels manageable. A 20% drop feels uncomfortable. A 40% drawdown feels existential. This is where psychology takes over. Loss aversion is stronger than the joy of gains. Studies in behavioral finance consistently show that the pain of losing money is roughly twice as powerful as the pleasure of gaining the same amount. When portfolios shrink, rational analysis is replaced by emotional survival. I just want to stop the bleeding. That sentence is liquidity. Institutions do not need to convince you that Bitcoin is worthless. They only need you to doubt your timing. They only need you to feel that you made a mistake. They only need you to think, I'll buy back later at a lower price. But markets rarely offer emotional comfort. By the time retail feels safe again, price has often already recovered. Look at historical cycles. During deep corrections, narratives shift dramatically. Long-term potential disappears from conversations. Short-term danger dominates attention. Macro uncertainty becomes the main topic. Regulatory threats resurface. Exchange risks are amplified. At the bottom, conviction is scarce. And that is precisely when large capital is most active. Accumulation rarely looks heroic. It looks boring. It happens when volatility compresses after a brutal sell-off. It happens when media coverage fades. It happens when retail participation drops significantly. You will not see fireworks during institutional buying phases. You will see exhaustion. Here is the uncomfortable truth. Markets are designed to transfer assets from the impatient to the patient. That does not require evil intent. It requires structure. Retail investors often buy aggressively after price has already risen significantly because rising prices feel safe. They sell aggressively after price has fallen significantly because falling prices feel dangerous. Institutions, with deeper pockets and longer time horizons, invert that behavior. When retail is excited, institutions distribute slowly into strength. When retail is terrified, institutions accumulate into weakness. This is the liquidity cycle. If you zoom out, Bitcoin has experienced multiple brutal drawdowns of 50%, 70%, even more. Each time, a wave of participants exits the market, convinced the experiment has failed. Each time, over longer horizons, the asset has recovered and exceeded previous highs. Who was buying during those moments of despair? Not the people tweeting in panic. Understanding this dynamic is the first step. Before we even talk about how fear is amplified, before we analyze the mechanics of liquidation cascades and media narratives, we must accept a simple structural reality. Large buyers need sellers, and the largest pools of sellers appear during fear. In the next part, we will go deeper into a more uncomfortable layer of this conversation. Because fear does not always grow naturally. It can be intensified, it can be amplified, it can be strategically triggered, and when fear spreads fast enough, liquidity becomes abundant. Fear in financial markets rarely arrives quietly. It spreads like wildfire. At first, it is just a red candle, then another, then a headline appears, then a thread goes viral, then a respected voice expresses concern. Within days, what began as normal volatility transforms into a narrative of collapse, and narratives move markets just as powerfully as numbers. It is important to understand something clearly. Institutions do not need a secret meeting room where they coordinate evil plans. They operate within a system that already rewards those who understand how fear works. They understand psychology, they understand liquidity, and most importantly, they understand that fear accelerates supply. Let's start with the most visible amplifier: media. When Bitcoin is rising 10%, the headlines are optimistic but measured. When Bitcoin drops 20%, the headlines become dramatic. Words like crash, bloodbath, and meltdown dominate news feeds. Financial television invites skeptics who predict catastrophic downside. Articles resurface old criticisms about intrinsic value, environmental impact, regulation, or exchange failures. Negative news travels faster than positive news. It generates more engagement, more clicks, more discussion, and repetition shapes perception. If you see 5 different outlets reporting that crypto is collapsing, your brain begins to treat that narrative as consensus reality. Even if the fundamental thesis has not changed, the emotional environment has shifted. But media amplification is only one layer. The second layer is structural volatility. Modern crypto markets are heavily leveraged. Futures contracts, perpetual swaps, margin trading. These instruments magnify price movements. When price drops to certain levels, forced liquidations occur automatically. Positions are closed. Stop losses are triggered. Algorithms sell. This creates cascades. A single sharp move downward can trigger a chain reaction of forced selling. What began as a normal correction becomes an accelerated drop. Retail traders watching the chart do not see liquidation mechanics. They see collapse. And collapse triggers fear. This is where institutions gain another advantage. They often understand where liquidity clusters. They know where stop losses are likely concentrated. They know which price levels, if breached, will cause emotional reactions. When price sweeps through these levels, it feels intentional. It feels targeted. Retail traders say, "They hunted my stop." Whether or not there is direct intent, the effect is the same. Stops are triggered. Coins are sold. Liquidity expands. Now add social media to the equation. During bull runs, timelines are filled with confidence. Influencers share price targets that seem inevitable. Communities reinforce each other's optimism. The emotional environment is supportive. But when price drops sharply, tone shifts almost instantly. The same voices become cautious. Some disappear. Others pivot to warnings. Screenshots of liquidated accounts circulate. Threads about why this time is different go viral. Human beings are deeply influenced by social proof. If everyone around you seems worried, your confidence erodes. You begin to question your thesis, not because the fundamentals changed, but because the crowd changed. Fear spreads socially. Another powerful mechanism is regulatory uncertainty. Even rumors of potential government crackdowns can trigger significant reactions. Headlines suggesting bans, restrictions, or investigations create ambiguity. Ambiguity is uncomfortable. Markets dislike uncertainty more than bad news itself. Institutions understand that regulatory narratives create volatility. They monitor policy discussions. They position accordingly. Retail investors, however, often react emotionally to incomplete information. Then there is the strategic use of extreme predictions. During major corrections, you will often hear bold downside targets repeated loudly. Bitcoin to 10,000. Bitcoin is going to zero. The bubble has burst permanently. Extreme predictions anchor expectations. Even if you intellectually believe Bitcoin has long-term value, hearing repeated catastrophic forecasts chips away at your emotional stability. The possibility, however small, begins to feel plausible. And doubt is enough. Behavioral finance teaches us that humans are not rational calculators. We are emotional processors. Loss aversion, recency bias, herd behavior. These are not weaknesses unique to retail investors. They are human traits. Institutions build strategies around these traits. When your portfolio drops 30%, your brain does not calmly calculate historical drawdowns. It activates stress responses. Cortisol rises. Your body interprets financial loss as threat. You feel urgency. I need to do something. That impulse is liquidity. Fear is not just about price. It is about uncertainty layered on top of volatility. A falling price combined with negative headlines creates narrative alignment. The story matches the chart, and when story and chart align, conviction breaks faster. Imagine holding Bitcoin for months, confident in its long-term potential. Then, a sharp crash occurs. News outlets talk about exchange insolvency. Influencers warn of systemic risk. Futures markets show massive liquidations. Your portfolio is down 40%. Even if you believed strongly before, the environment now feels hostile. You are no longer evaluating fundamentals. You are evaluating pain. Institutions, on the other hand, are evaluating opportunity. They ask different questions. Has the network stopped functioning? Has adoption reversed permanently? Or is this volatility within a broader cycle? If their thesis remains intact, falling prices represent discounted entry. Here is the subtle but critical point. Fear does not need to be fabricated from nothing. It only needs to be amplified. Markets naturally fluctuate. News naturally occurs. Regulations naturally evolve. But when these elements converge during a downturn, the emotional intensity multiplies. And intensity creates sellers. Institutions do not need every retail investor to panic. They only need enough of them to release sufficient supply. Even a fraction of fearful holders can generate enormous liquidity when combined with leverage-driven selling. The result is a transfer. Coins move from those who cannot tolerate uncertainty to those who are prepared for it. By the time the fear subsides, the selling pressure has already done its work. Stronger hands hold larger positions. Weaker hands hold regret. In the next part, we will most painful stage of this cycle, the moment of capitulation. The moment when retail investors do not just feel fear, but exhaustion. When they are not selling because they think it is smart, but because they can no longer endure the emotional weight. That moment is where the transfer becomes complete. There is a specific moment in every market cycle that does not show up clearly on charts, but you can feel it if you have lived through it. It is not the first drop. It is not even the biggest drop. It is the moment people stop arguing. In the early stages of a correction, retail investors are still confident. They call it a dip. They post charts comparing the current pullback to previous ones. They reassure each other that volatility is normal. Then the decline continues. Price falls another 15%, then 25%, then 40%. Each bounce becomes weaker. Each recovery attempt fades faster. Optimism slowly transforms into defensiveness. This is where psychology begins to crack. At first, there is denial. It's just market noise. Then hope. It will bounce back soon. Then anxiety. Why isn't it recovering? Then panic. What if this time really is different? And finally, exhaustion. Capitulation is not loud. It is tired. It is the investor who once checked the chart every hour now refusing to look at it. It is the long-term believer saying quietly, maybe I was wrong. It is the leverage trader closing positions not because of strategy, but because of emotional collapse. When people talk about retail selling the bottom, they often imagine stupidity or ignorance. In reality, it is rarely about intelligence. It is about endurance. Endurance is scarce during prolonged uncertainty. Imagine holding Bitcoin through months of declining prices. Your portfolio is down 50%. Friends who once asked you how to buy are now asking if you are okay. News outlets barely mention crypto unless something negative happens. Social media engagement shrinks. Conversations move on to other trends. Silence replaces hype. This is where the real transfer occurs. Retail investors do not sell at the top because they feel safe. They sell near the bottom because they feel unsafe for too long. The human nervous system is not designed for extended financial stress. The longer volatility persists, the heavier it becomes. Eventually, many reach a breaking point. I can't do this anymore. That sentence is the final release of supply. From a structural perspective, capitulation often coincides with sharp spikes in volume, a final flush, a dramatic wick downward. Liquidations cascade one more time. Stop losses that survived earlier drops are finally triggered. It looks like chaos, but beneath the chaos, something else is happening. Strong hands are absorbing. Institutions rarely announce accumulation during these periods. They do not go on television declaring, "This is the bottom." They quietly execute, sometimes through over-the-counter desks, sometimes through gradual spot accumulation, sometimes by providing liquidity when others demand it. While retail retreats, institutional positioning expands. What makes this dynamic powerful is that it is self-reinforcing. As more retail investors exit, volatility eventually decreases. Selling pressure weakens. The market stabilizes, not because optimism returns, but because the sellers are exhausted. Exhaustion is a turning point. When there is no one left desperate to sell, downward momentum fades. Price may not immediately skyrocket, but it begins to form a base. Sideways movement replaces violent swings. News coverage becomes minimal. Interest declines. Ironically, this is when risk is often lowest. But emotionally, it feels the least attractive. Retail participation during these phases drops dramatically. Search trends fall. Trading volumes shrink. Influencers shift to other topics. Those who were burned swear they will never return. I'm done with crypto. That declaration is common near cycle lows. Yet history shows that cycles reset. Bitcoin has experienced multiple drawdowns exceeding 70%. Each time, the narrative declared it finished. Each time, over longer horizons, the asset recovered and surpassed previous highs. The difference between those who benefited and those who did not often came down to one factor: emotional resilience. Institutions are not immune to losses. They are not omniscient, but they are structured differently. They operate with longer mandates, diversified capital, and predefined strategies. They expect volatility. It does not surprise them. Retail investors often enter the market during expansion phases, when price appreciation feels steady and inevitable. They are unprepared for contraction. When contraction arrives, it feels like betrayal, and betrayal accelerates exit. There is another subtle layer to capitulation: identity. Many retail investors attach part of their identity to being early adopters, believers, or members of a movement. When price collapses, it does not just threaten their portfolio, it threatens their self-image. Admitting doubt feels like admitting failure. At some point, selling becomes not only financial relief, but psychological relief. Closing the position closes the stress loop. It provides immediate certainty in exchange for potential future upside. Certainty is seductive during chaos. Institutions understand this trade-off deeply. They know that in moments of maximum uncertainty, assets are often mispriced. They know that volatility expands perceived risk beyond actual long-term impairment. They wait for that gap. Capitulation marks the final stage of fear's evolution. It is no longer sharp panic. It is surrender. And surrender is efficient. It releases large quantities of supply quickly. Once that supply is absorbed, the structure changes. Price may still drift, news may still sound cautious, but the underlying distribution of coins has shifted. More Bitcoin now sits in the hands of those who endured the storm. Retail investors who exited watch from the sidelines. They promise themselves they will re-enter when things look better. But when things look better, price is often already significantly higher. And so the cycle continues. Assets move from impatient hands to patient hands, from emotional decisions to strategic positioning, from those who react to fear to those who anticipate it. In the final part, we will confront the most important question of all. If this cycle is structural and recurring, how can retail investors avoid becoming the liquidity that fuels institutional accumulation? How can individuals break the loop of buying optimism and selling fear? Because understanding the game is one thing. Refusing to be its fuel is another. By now, the pattern should feel uncomfortably familiar. Excitement builds slowly, then all at once. Prices rise, confidence expands. Retail investors enter aggressively because rising markets feel safe. Institutions distribute quietly into strength. Then volatility returns. Price falls, headlines darken, leverage unwinds, fear spreads faster than logic. Retail investors sell to stop the emotional pain. Institutions accumulate quietly into weakness. The cycle resets. The uncomfortable truth is this: institutions do not need to defeat you. They only need you to react. Markets are not designed to reward intelligence alone. They reward emotional discipline, and emotional discipline is rare during chaos. So the real question becomes, how does a retail investor avoid becoming liquidity? First, you must understand that fear is not an accident. It is a feature. Fear is amplified through multiple channels at once. Violent price swings trigger stop losses and liquidations. Media headlines emphasize worst-case scenarios. Influential voices publish extreme downside predictions. Regulatory uncertainty is framed as existential threat. Social media shifts tone almost overnight. Individually, each factor may be manageable. Together, they create psychological overwhelm. When price drops 30% and every signal around you reinforces danger, your brain interprets alignment. The chart says collapse. The news says collapse. The crowd says collapse. Even if fundamentals remain intact, the emotional narrative feels complete. This alignment is powerful because humans crave certainty. When negative signals align, selling feels rational, but alignment can be misleading. Volatility does not equal failure. Price decline does not equal value destruction. Temporary uncertainty does not equal permanent impairment. Yet in the middle of fear, those distinctions blur. Institutions rely on that blur. They do not need you to believe Bitcoin is worthless. They only need you to believe that holding it is unbearable. Unbearable leads to action. Breaking the cycle begins with reframing volatility. Instead of asking, why is this crashing? The better question is, has the long-term thesis fundamentally changed? If the network still functions, adoption continues, and macro drivers remain intact, then volatility is not necessarily collapse. It is compression. Retail investors often enter markets with undefined time horizons. They say they are long-term investors, but emotionally they operate on weekly or monthly feedback. When price declines over several months, the psychological mismatch becomes painful. Institutions define their horizon before they allocate capital. This difference matters. If you enter Bitcoin with a multi-year thesis, but evaluate your decision daily, you create constant emotional friction. That friction increases the probability that you will sell during amplified fear. Another critical factor is leverage. Leverage is seductive during bull markets. It accelerates gains. It creates the illusion of skill. But leverage turns normal volatility into existential threat. A 15% drop that would be manageable in spot markets becomes catastrophic in leveraged positions. Liquidations are not philosophical, they are mechanical. When price reaches certain levels, positions close automatically. The market does not ask about your conviction. It does not care about your research. It simply enforces margin rules. This mechanical selling contributes to cascades. Cascades amplify fear. Fear accelerates voluntary selling. Institutions understand how leverage concentrates risk. Many of them either avoid excessive leverage or use it strategically with strict controls. Retail traders often use it emotionally. Reducing or eliminating leverage removes one of the strongest fear amplifiers from your personal equation. Then, there is position sizing. If your Bitcoin allocation is so large that a 40% drawdown disrupts your sleep, you are structurally vulnerable to capitulation. Fear intensifies when financial survival feels threatened. Institutions manage exposure relative to total portfolio risk. Retail investors often overconcentrate because of conviction. Conviction without risk management becomes fragility. To avoid becoming liquidity, you must survive volatility. Survival is underrated. It is not glamorous. It does not generate social media applause, but it preserves optionality. Another overlooked element is information diet. During crashes, constant exposure to negative news magnifies stress. Algorithms promote extreme content because it generates engagement. If you consume hours of catastrophic predictions daily while watching your portfolio decline, your nervous system remains in fight or flight mode. In that state, long-term thinking is nearly impossible. Institutions filter information through structured processes. Retail investors often absorb it raw. Controlling input reduces emotional distortion. Perhaps most importantly, understand that markets transfer assets from those seeking emotional comfort to those tolerating discomfort. When you sell solely to relieve anxiety, you exchange potential future upside for immediate psychological relief. There is nothing immoral about institutions buying what you sell. This is not a battle between good and evil. It is a difference in preparation. They prepare for volatility. Most retail investors prepare for continuation. The shift required is internal. Instead of asking how to outsmart institutions, ask how to outlast your own emotional reactions. Instead of predicting exact tops and bottoms, focus on aligning your strategy with your risk tolerance and time horizon. Fear will always exist. It will be amplified through price shocks, headlines, expert opinions, and social contagion. There will always be moments when the narrative feels overwhelmingly negative. But fear only converts into liquidity when it triggers your action. If you define your thesis clearly, size positions responsibly, avoid destructive leverage, and accept volatility as structural rather than catastrophic, you reduce the probability of selling at the worst possible moment. You cannot control headlines. You cannot control regulatory discussions. You cannot control macroeconomic shifts. But you can control how exposed you are to forced decisions. In every cycle, there are those who exit at maximum pessimism and those who accumulate quietly. Years later, the narrative focuses on price appreciation and institutional adoption. Rarely does it highlight the emotional transfers that made that appreciation possible. Markets do not steal from you. They test you. They test your patience when price moves sideways. They test your conviction when price collapses. They test your discipline when price skyrockets. Institutions obtain Bitcoin from retail investors, not simply because they are bigger, but because they are structured to withstand fear. If you want to avoid becoming the fuel of that structure, the solution is not paranoia. It is preparation. In the end, the most important question is not whether institutions are creating fear. It is whether you understand that fear well enough to refuse to surrender to it.